probably makes sense. Have a conversation. We can review your situation, not from a necessarily a filing, but just fresh set of eyes to look at it from a strategy perspective and see if there's anything we could do to optimize it, make it more efficient, save you some tax, and just set things up going forward to be a little bit better. This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. All right, we're back. It's Friday. We just got through tax season. It's May 1st, made it through the tax deadline. So we're going to talk a little bit about taxes and the market. Pretty good week, pretty good day yesterday in the market as well. So the recovery has continued. But how you doing over there, Greg? What's going on? What's happening today?
Yeah, well, start of a new month, May 1st. So, Will, does that mean hockey season officially over? Or is there still some lingering effects? Or
It's not official. It's now we're in the tryout season. So we've been doing tryouts the last few weekends. So it's we got some more tryouts this weekend, which is fun. But no, it's good. Hockey. I don't know if we talked about this, but hockey is something else for youth hockey. It's good. I've joked that it's almost like professional hockey, but with 8 or 9-year-old boys. So if you can imagine what that's like, that's what we've been navigating the last little while.
oh, that's so fun. Well, it's like being part of a professional environment, but you got a horse in the race with Connor.
Yeah, it's good. It's fun. He's doing well. He's enjoying it, and it's cool. I was never a big hockey guy, so I'm learning a lot about it as I go. I think I was just a lowly house league
Hey, okay.
player when I played, but no, he's coming along. He's doing well. He's having fun and enjoying it. So I'm sure Leo will get there. You got him. Is he kicking a soccer ball or anything like that?
So it's funny. It's funny you say that. So we're obviously he's learning to walk, and he walks around the house holding our hand. He's not kicking a soccer ball. He's kicking his little like play phone though.
Oh,
So
there you go. You
he's on the right
got him
path.
started early. There you
Yeah,
go.
he's on the
That's good. That's awesome. We want to talk a little bit, I guess, just quick update. I know last couple weeks we did some more specific themes in our portfolios, got into some more detailed topics. We talked about commodities, which in this environment have been doing well, and semiconductors and chips and the whole AI theme, which has been doing very, very well. So that's great. I mean, we just went through tax season for clients the last month or so, which is always lots of work for everybody. And we wanted to talk a little bit about tax strategy versus just tax filing and tax returns. So just talk something more practical, more financial planning related, as opposed to some of the more complex or big picture ideas about portfolios and markets. So looking forward to talking tax here with you, Greg.
Yeah, absolutely. And this is the time, well, like I know everyone's maybe like doing a little bit of sigh relief. Okay, tax time's over. I've filed. I don't have to think about it. But this is actually probably the best time to say, okay, we've just filed tax. So maybe look back at the last year, look forward to this year and say, okay, let's look at some practical strategies that we can implement this year going forward.
Yeah, I mean the great thing is it's top of mind already. I would agree that a lot of people probably don't want to look at their taxes again until next year after going through everything that's involved. However, you probably have your 2025 return right in your inbox. It's readily available. It's top of mind to look at. Understandably, like we work with a lot of great accounts. We've got lots of fantastic accounts in our network, but this time of year, that's exactly what they're doing. They're doing filings, they're doing returns, they're crossing the T's, they're dotting the I's because they want everybody's return to be squared away and finished. It's very hard to come in at this point or in April and say, all right, let's do some strategy. And frankly, for the next little while, a lot of the corporate returns then get done as well. But it's a great time to look at and say, all right, let's do some strategy. And often that's where we'll come in as advisors and with our financial and wealth and retirement and tax planning expertise and work that we'll do with clients is look at your tax situation, your overall financial picture, take a step back and look, what can we do strategy wise? Because filing is one thing. what's done is done. There's not much that can be done to change that. But if we can look forward about how things are structured for 2026 and beyond, we are only 4 months into the year, so not that much has happened. There's still time to make shifts and adjustments or set things up better going forward. This is a really good time to do that and look at that.
Yeah, in terms of strategy, well, it will probably depend a little bit about kind of the age and the stage of the client in which they're in. So you kind of have maybe retirees, you have kind of the working like T4 income employees, maybe the higher net worth, and then kind of the corporate clients are kind of their own separate bucket. But maybe just starting with kind of the retired folks, are there any or what are kind of some of the strategies that should be top of mind?
Yeah, well, we could both probably talk a little bit about that, but yeah, that's certainly for us. We've got a good number of retired clients and clients who have moved through that into that phase with us and are drawing down. So I mean, it's probably where there's a lot of opportunities because typically you're not going to be not always but often you're not necessarily in the highest marginal rate in terms of income and taxes. So how you draw down that income matters. I mean, things like income splitting are a big one. Making sure you have the right type and proper investment income. Even looking at things like withholding taxes and just tax rates on those withdrawals, and make sure that you're optimizing CPP, OAS. Looking at those to make sure those are being handled properly. So there's a lot of different areas. There's deductions as well that would be available, but often retirees, we can sharpen the pencil a little bit and look at it and look at where things are being drawn from and just work to line that up just to make sure things are streamlined and optimized. I mean, what about from your end? What do you see with our retired clients, Greg?
One of my favorite things to do is like kind of that window between like when you're 71 and when you're retired. There's a window in there that I think is actually very, very key. And that's like what we call an RSP meltdown. So that's kind of sharpening our pencils to your point, looking at the taxable income and not just automatically delaying taking RSPs or RIFs until you actually have to, but looking and saying, okay, is there an amount that we can pull from every year that's going to create just the right of taxable income to keep the tax level smooth as possible through retirement, as opposed to just, as an example, drawing from non-registered assets until you're forced to take money from your RSP and RIF, and then your taxable income goes up. So I would say that's a really big key one, is just making sure your income is as smooth and efficient through retirement as possible.
Yeah, that's a good one. The meltdown, then that's a great strategy. Often you're making that transition. Clients are making that transition. Retirement. We'll look closely at that for sure. And to that point, like things like CPP and OAS. I mean, there's no hard and fast rule necessarily, but a lot of times what people do is they'll take CPP and OAS right away at 65 for a whole host of reasons, but then delay drawing on the investments until 70 71, or really it's the 72nd year, which some situations I understand it can make sense. But if you look at sort of textbook financial planning and tax planning, the opposite often makes more sense, which is actually delaying the CPP and OAS and then melting down those RSPs and doing earlier RIF withdrawals for your income and your cash flows. The tax planning, especially for retirees, is one of those important pieces. And oftentimes through our own work, one of the things we've done the last year and a half at Aretec has been working with independent certified financial planners as well, which has been awesome. But we do a lot of planning work around that. Our financial planning partners do that as well, and there's a lot of efficiencies often that can be found. You also, I think, with that, you want to make sure just cash flow and income is streamlined. So it's not necessarily a tax savings idea, but if you can streamline that cash flow so that's showing up in your bank account every month and you line up taxes and withholding taxes, all that properly, it takes a lot of stress points off life and retirement so you can enjoy your wealth, enjoy your money, and enjoy life.
Yeah, absolutely. That's our motto. One last quick point before we move on to the next group is that, to your point, Will, we'll do a lot of planning. And through the plan, we can see, well, if we draw down your retirement income this way, it actually makes the plan look a lot better as opposed to doing it that way. So that's kind of where the planning will also tie into this as well.
Yeah, often well, on that point, often with just proper drawdown strategies, that can be over the life of a plan, that can be a big time optimizer where it could be, not in 1 year, but if you look at it over 20, 30-year retirement, you could save 20 or 30% in taxes overall by doing that properly and optimizing, the drawdown just not only for yourself, but for the estate and the next generation. So, definitely one that's worth having a conversation around.
Yeah, absolutely. So the next group will. So think of this as kind of your T4 employment income. I mean, the tax strategies are getting fewer and fewer, it seems, over the years, but there's still a couple good ones that we want to make sure we're taking advantage of.
Yeah, and I mean, the basics, and I think the RSP, maxing those out, TFSAs, just the registered accounts in general. We had done a video a little while back, the FHSAs as well, taking advantage of that. That can also be for older clients who wanna help out kids and grandkids and contribute. FHSA is typically a great place to contribute and help kids out. TFSA is probably a close second just because the deductions that are available helps with the first home buyers. Could be the RESP, that can be parents, grandparents often want to help out. There's a little bit of complexity as well. If you're the grandparent contributing to the RSP, probably something that we could talk about. Anyone who's interested in that, not in the video outside of that, but that's the main thing. You want to make sure that you're maximizing those. We also see it with your typical say corporate employee who's you working at a company and you're still in that accumulation and wealth growing phase. You want to make sure your corporate plans you maximize that because that's something that's not easy to replicate for us. Making sure any kind of matching or benefits that you're getting from putting funds into corporate plans you're taking advantage of. There's more creative ones like maybe we talk a little bit about things like as you start to get a little bit more complexity, things like debt swaps and Smith maneuvers and interest deductibility tends to be one with clients that are still in that accumulation phase that is interesting. So maybe we could talk a little bit about that as well.
Yeah, so a lot of T4 employees, like when they are kind of really in the middle of their, high earning years, they could potentially still have a mortgage and they could also still potentially be building up after tax funds. So outside of the RSPs, TFSAs. So a really simple one, which gets clients a pretty good interest deduction that we've looked at before is just seeing if we can structure the debt and structure the plan to get you some interest and tax deductions. So one is this concept to your point, Will, about a debt swap, where if you have cash on hand, potentially paying down some of that mortgage or all of the mortgage, and then re-borrowing back into the investment portfolio. So in this case, you haven't taken on any more or less debt. You've just kind of moved the chess pieces around, and what you've done is you've made an interest deduction. So it's things like that where we can start getting a little bit more creative.
Yeah, if you look that up, you hear that talked about the Smith maneuver, the debt swap, and the idea is just creating an interest deduction on your borrowing where you didn't have it before. And I think, I mean, our general philosophy on that is we can get interest rates down for you, and we can make them deductible. That's going to be a win. It reminds me actually of more of a retired strategy or another strategy, not necessarily for retirees, but the reverse debt swap strategy, which I don't know if we invented that one or maybe the name, but there's another idea. That's if anyone's interested in that, we probably could do a whole video. We may have done a video in the past on that too, but talk to us. But it's a similar idea for just creating retirement income that creates interest deductions and creates cash flow and some efficiencies. The reverse debt swap. We might have to trademark that one at Aretec.
That was all you. Will coined and trademarked that term, so we'll give you the credit for that one.
Yeah, maybe we'll save it. We'll save that for if anyone wants to talk about it, reach out to us. We could explain the strategy to it. But it's an interesting one for sure. And we've had a number of clients successfully implement it, and it can work really well as a planning strategy.
So for now, we've kind of gone from T4 employees and like moving closer to that like higher net worth like individual who still might be like a T4 work employee. Like, are there any drastically different strategies, or is it just that they're maybe more meaningful now?
No, I mean, I think just as investors, when you start to look at families and higher net worth or even ultra high net worth families, just as more wealth grows and accumulates, we start to then look at things like we run into concentrated positions and capital gains and investment income planning, like dividends versus interest. I think that the general concept there is that with your open accounts, your the joint accounts, the taxable accounts, if we can make that income as efficient as possible, that's great. Typically, capital gains, although it's always frustrating. Like we had a great year last year in the portfolio, the market. Generally speaking, there's gonna be some taxes to pay, which is a good problem to have. But capital gains, all things being equal, is going to be better than say interest income. And yes, Canadian eligible dividend income is efficient and on the margin. So is U.S. dividend income, at least relative to interest income. But ideally, we don't want to have, which most of our clients, that's not the case, too much money that's just parked in GICs or fixed income and that sort of thing. And then there's things, there's more advanced strategies for sure dealing with concentrated positions. Sometimes we look at some more advanced strategies to defer those gains and do some things like exchange funds or those sorts of things. Definitely more on the advanced radar. Family trusts is another one that we then sometimes will foray into. That probably explaining the family trust
Own separate video.
probably its own video, but I think the point is from a big picture, probably makes sense, have a conversation. We can review your situation, not from a necessarily a filing, but just fresh set of eyes to look at it from a strategy perspective and see if there's anything we can do to optimize it, make it more efficient, save you some tax, and just set things up going forward to be a little bit better.
Well, there's usually one or two, like looking at a situation, there's usually one or two things that we can do that aren't going to be, drastic, like huge changes, but they're going to have a pretty big impact to cash flow, taxes, deductions. So that's kind of what the lens that we look at it from.
Yeah, for sure. If we could find anything in there that's gonna make things more efficient, that's gonna be a win. And then the last one that is a little bit more complex as well as any sort of corporate structure, business owners, and we've got lots of clients who fall into that. It's only to say if you have a corporation, if you have a business structure, there's definitely quite a few more advanced strategies that could be available in there. So if you have that corporate structure, it is probably worth a conversation, probably worth a discussion to talk about making sure that's all done all properly and squared away. Just because there's a lot of wrinkles that come in the corporate structure. So that's probably the extent of what I'd look at there.
Yeah, and the corporate structure, like we don't have to get into it, but like, there's the capital dividend account, even taking salary versus dividends, like we can help with that. There's also like life insurance through the corporate structure, which tends to be pretty efficient. So with the corporate structure, you get a little bit more creative and broad with some of the strategies.
Lifetime capital gains exemption, that's another one, right? There's all it probably be its own not only video but textbook. But here's the idea is strategy makes sense. Now is a good time into the spring. It doesn't have to be today or tomorrow, May 1st, but looking at that, getting ahead of it. The tax returns are just done now. So feel free to reach out, have a conversation. If we can save you some tax, it's probably going to help you be a little bit wealthier, put a little bit more money in your pocket. So we want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. That's what we're all about. That's what Aretec Wealth is all about. Have a great weekend, everybody, and we'll be back with you next week.